Tuesday, August 20th, 2019, Maneco 64, home of alternative economics and contrarian views. This morning, I want to talk about the counterproductive monetary policy of the Fed. That's an essay by Antal Fekete of the New Austrian School of Economics. He wrote this, I think, in 2014. And it says sowing inflation, reaping deflation. I'm not going to look at the whole essay, but at the part of the essay where he actually explains why falling interest rates is a destroyer of capital, and it only helps speculators. Before that, of course, I'm going to quickly look at where the markets are this morning. I'm a little earlier today. It's 7:09 a.m. London. So we've got spot gold at $14.98. It's up about a couple of dollars. Range has been $14.93 to just below $1,500. $14.99.95 I have as a high. So yesterday we had a negative day for precious metals. Not surprising. We've been on a tear for the last few months in precious metals. Just taking a breather. Silver got hurt. Silver 1696, up 10 cents or 0.5%. Stock market continues to go higher here. The Dow is up 60 points or 0.25%, 26,193. S&P 2630, that's up just under 7 points, 0.25% as well. NASDAQ 100 future up 0.25% or 20 points at 77.40. So I saw a lot of headlines coming out yesterday saying that the markets are more comfortable. It looks like the economy has averted the recession, that recovery is going to be the key word, that there's stories about the German government now looking to do fiscal stimulus, even though I talked about this yesterday, I think it was in my video, that the German government actually runs a surplus. So that's just speculation. Also speculation that in spite of a huge budget deficit, that the U.S. Government is going to look to cut taxes more. I'm not against low taxes, but when you cut taxes and you don't cut government spending, that's not a good thing. So reading this book here, Golden War, it talks about how in the 50s and 60s, under Truman and Eisenhower, if they're going to spend more government spending, if that was going to increase, they always raise taxes. So to have a balanced budget, right? So you can't have both. So that's what it means, more deficit spending. Currencies, fairly quiet here. The pound is unchanged, 121.24. Euro is at 110.84, also unchanged. Dollar is down 0.15 versus the yen at 106.48. And the dollar is slightly lower against the yuan at 706.82. Crude oil, WTI is up just over 1/3% at 56.35. And Brent crude is also up over 1/3 at 59.61. So crude oil not moving anywhere really, quite steady around these mid 50 levels for WTI and around 60 for Brent. Bond market yields did rise yesterday with the risk on trade, so to speak. There's hope as well now that the Fed will cut rates. Well, not hope. It's almost 100% discounted that the Fed will cut rates on the 18th of September. We have also Powell making a speech on Friday at the Kansas City Fed Symposium in Jackson Hole, Wyoming. Not only will there be U.S. central bankers there, but central bankers from around the world. 10-year yield right now is at just below 160 at 159. So I think last week we got below 150, so it has risen, but it could very quickly go back down. The 3-month yield is at 194. So we're about 34 basis points inverted, 3-month to 10-year. The 2-year is at 152.20. So that was inverted last week, but it has quickly disinverted. So the counterproductive monetary policy of the Fed, and you can add all the other central banks to this. And before I go on to the interesting section about how falling interest rates is actually a destroyer of capital, I just want to look at the beginning here of this essay, the introduction, and I'll read through it. It says, typically bond speculators carry on interest arbitrage along the entire yield curve. They sell the short-term maturity and buy the long, hoping to capture the difference between the higher long rate and the lower short rate of interest, borrowing short and lending long. This arbitrage is not risk-free per se, as it has the effect of flattening the yield curve. As a result, the normal yield curve could get inverted unexpectedly, that is, turned upside down, making the rising curve into a falling one while turning speculators' profits into a loss. And then he goes on to say, however, as a direct result of the policy of open market operations introduced clandestinely and illegally in 1922 through the conspiracy of the U.S. Treasury and the Federal Reserve, long before the practice was legalized ex post facto in 1935, interest arbitrage was made risk-free. Astute bond speculators could thereafter preempt Fed action profitably. It never fails. Speculators know that sooner or later the Fed will have to go to the bill market to buy in order to boost the money supply. They will buy beforehand. On rare occasions, the Fed would be a seller. Then speculators, perhaps acting on inside information, will sell beforehand. This copycat action is an inexhaustible source of risk-free profits. Thanks to the Fed's open market purchases, speculators are assured that they will always be able to dump the bonds at a profit, which they have bought preemptively. The more aggressively the Fed persists in its effort to increase the monetary base, the greater the bond speculators' profits will be. So it just shows you that who the Fed is really favoring with its operations. It's not the general public, but the speculators. And he goes on to say, absolute bad faith. Following the 1921 disastrous collapse in the U.S. Treasury bonds, the ongoing conspiracy between the U.S. Treasury and the Fed was formalized in 1922. The policy of open market operations by the Fed was inaugurated. Ever since, Federal Reserve credit has routinely been created on the collateral security of the debt of the United States government. Thus, the Federal Reserve Act of 1913 was overthrown without fanfare, while Congress was looking the other way. As a result, the Fed has been subverted. According to the original act, collateral for the notes and deposit liabilities of the Federal Reserve banks were to be restricted to real bills, that is, short-term commercial paper originating in the domestic production and distribution of consumer goods. Treasury paper was not listed in the act as eligible assets. This was not an oversight. No part of the Federal Reserve credit outstanding was supposed to be built on government debt. If a Federal Reserve Bank was found short of eligible paper in balancing its note and deposit liabilities, it did not matter how great an overflow of Treasury bills it might have in its capital accounts. It was fined according to a stiff progressive schedule of penalties for deficiency of collateral. So it says the conspiracy between the U.S. Treasury and the Fed started in 1914. Almost on the same day, the 12 Federal Reserve banks opened their doors for business. The decision was made at the highest levels by President Wilson that the Fed be diverted from its original mission and be put to use in financing the war effort of the Entente Cordiale. There you go, World War I, the excuse. So I won't go further into that. I'll put this the link to this essay in the description. You can read the whole thing. It's very interesting. So this is the interesting part here. Falling interest rates as a destroyer of capital. Open market operations make a regime of falling interest rates. My thesis that falling, as distinct from low stable interest rates, destroy capital across the board is admittedly controversial. I would welcome its examination without fear and favor by a competent and unbiased panel that could also examine the superiority of self-liquidating credit over credit based on government debt. That could be called tongue-in-cheek self-perpetuating debt. We shall look at 3 destructive effects of a rate cut. A, the increase in the liquidation value of debt. B, labor's deteriorating terms of trade. C, the fading of depreciation quotes. So I'll focus on the increase in the liquidation value of debt here. And it says, the proposition that the bond price varies inversely with rate of interest is uncontroversial and universally accepted by friend and foe alike. It describes the effect from the point of view of the creditor. Curiously, people find it hard to comprehend the equivalent proposition describing the very same effect from the point of view of the debtor, namely that the liquidation value of debt also varies inversely with the rate of interest. In particular, a rate cut increases the cost of liquidating debt before maturity. Liquidation value is what the debtor must pay if he wants to retire his debt ahead of schedule. As this liquidation value is now higher, falling interest rates make the burden of debt increase. For example, if the rate of interest is cut in half, then according to the rule of thumb, the liquidation value of long-term debt is doubled. That is, to liquidate the debt will cost twice as much as it did before the cut. So there you go. This goes to the ECB as well, and the Bank of Japan, all the other central banks who think this is going to help, pushing speculators to buy this debt, to drive down yields and interest rates. It's only making things worse. And what about labor? Well, labor, as he says, the terms of trade for labor decrease. And why is that? Well, because companies focus on, how can I say, issuing more and more capital, more and more debt to increase capital expenditures. They try to, how can I say, through technology, automate production because they get squeezed as well because the cost of carrying the debt increases, so they have to lower prices, they have to squeeze labor. He doesn't argue against low and stable interest rates. What he argues about is the damage that what we've got right now, the rapidly decreasing interest rates, the damage it does to everyone. The only people who benefit are the speculators who have been, the bond speculators who have been in charge of the Federal Reserve and the country since 1914. So there you go. If you enjoyed this video, make sure you hit the like button, subscribe to the channel if you haven't yet. You can also follow me on Twitter, Steemit, and on DTube. I wish you all a great day. Take care. Bye.